Good afternoon, everyone. Thank you so much for joining us for today's free webinar on raising angel money with Kevin Smith from Seed Change. We were going to have Sir Crow from Early Growth also on the presentation, but it's just going to be me today. So I'm Erica Malsberg, the Chief Marketing Officer for Early Growth Financial Services. So I'll be the moderator and taking all your questions today. This presentation is going to run about 40 minutes or so. If you have questions as we go along, please feel free to enter them right into the question field. You can also tweet them to us at EarlyGrowthFS with the hashtag AngelMoney, and we'll make sure to follow up on those questions over the course of the day if you tweet them to us. It's possible to just raise your hand, but don't waste your time raising your hand. Just jump right in with those questions. We'll answer them as they come, or we'll wait till the Q&A at the end to get to them. You're also going to receive a follow-up email tomorrow with a link to the deck and the recording, and that will give you the contact information. So if you have follow-up questions, feel free to reach out to us after this presentation. So I want to start today by introducing Kevin. Kevin Smith is the co-founder and CEO of Seed Change. He's also the founder of The Vault, which is a startup co-working and incubation space here in San Francisco. In his previous lives, he led the development of new iShares products and businesses around the world, including development and introduction of equity and fixed income ETFs and expansion of iShares to Mexico, Australia, Brazil, Chile, Peru, and Colombia. He also ran IPOs, acquisitions, and other transactions for tech companies in Silicon Valley at Davis Polk & Wardwell. And he co-founded and led a business consulting firm in Moscow from startup phase to profitability as the largest consulting group in Eastern Europe. So good afternoon and welcome to you, Kevin.
Thank you. You can tell I get bored easily, huh?
Yeah, you've been pretty busy, it seems, and that's only, I think, a little corner of your resume there. So before we jump in, can you just start by saying a few words about Seed Change?
Sure. Seed Change is actually kind of the cornerstone of this presentation. We started out a few years ago to try to fix the early stage investing market. What we saw was that seed investing had really changed over the last 10 or 12 years. Venture capital funds no longer do early stage for the most part. They've kind of moved up the chain as the size of their funds has gotten big enough that they can't really deploy $250,000 or $500,000 at a time. That left a real gap in the funding market, and we thought we could help fix that in part by importing some of the standards and procedures and processes that work really well in the public company markets into the private company markets, and by automating and standardizing the investment price process and making it a lot more transparent and more opaque for both investors and companies. And we started off by talking to more than 100 different active angel investors. What we really wanted to understand is how do experienced seed investors make investment decisions, and what I really wanted to be able to do was draw out the decision tree from the moment an investor gets that first email or introduction to a company to the moment she or he writes that check. What happens? What are all the decision points along the way? How does this work? What does an angel want to know? What kind of data? What kind of presentation? And based on what we learned, this is how we developed our online platform. Novel enough, I think, that we were able to file a patent application for it as a private company investing platform, kind of a one-click investing platform. And that's still what we do. We work with early stage companies. We've been called, and I didn't totally dislike the name, we've been called the Goldman Sachs for startups. And that's really what we aspire to be, is to really help early stage companies get good funding fast and easy and totally compliant in a regulatory way, and also help investors get access to thoroughly vetted, well-diligenced, properly analyzed companies with the information presented to them just as they're used to getting information about investing in public companies.
Right, great. And and that's exactly why everyone signed up to come listen to you today, right? To have some of that transparency into the investing process, right? What goes on there and how to be more lucky in the process, I guess. Before we dig in, I just want to say a short bit about Early Growth Financial Services too. We're an outsourced financial services firm that provides accounting, strategic finance, CFO, tax, and valuation services and support to small to mid-sized companies at every stage of the development process. We're currently operating in 9 markets from Silicon Valley to New York City and have 475 active clients across the United States and internationally. Clients include such companies as TechShop, Indiegogo, Ouya, Zendesk, Clout, RocketSpace, OpenERP, and so many more great clients that we're just really excited about. If you're interested in learning more about us, feel free to check out our website, and we even offer a free 30-minute financial consultation. So if you are a founder and you have some questions about your company, that might be a good thing to sign up for. That said, let's go ahead and dig right in here. So let's start at the beginning, Kevin. Who is an angel? Can you tell us a little bit about sort of the makeup of an angel investor?
Well, in order to find early stage investing, you gotta know who you're looking for. So there is a decent amount of data, and we have our own data as well that we pulled from analyzing the early stage investment market, primarily in the Bay Area, but that's primarily where early stage investment funding comes from, but also in other parts of the country and a few other markets in the world as well. Your average angel is, middle-aged, probably coming out of the tech industry, or perhaps something related to the tech industry like finance or law. Obviously really well educated, got a decent amount of money, typically understands a little bit about this market. This is not the real angel investor isn't looking at this as buying a lottery ticket, or isn't someone who's tossing in $25,000 just because you're his neighbor's daughter. It's usually somebody who's been around the startup market in some way or another and understands generally what the risks and the potential returns are like. The average active angel looks at several dozen startups a year. The grand prize is a guy that I know, senior executive in a large public tech company here, who for several years has said he tries to see 50 per week. I haven't got a clue how he manages to do that, because he's actually CEO of a division of this company. So I'm sure he's got plenty of work to do in his day job. But he claims that that this is a really important piece of both his life, his career, his hobby, as well as his investment, investing on his own personal investing. A lot are also members of angel groups, although I think there's a real differentiation between who's a member of an angel group and who's not. Some are active, formal members of an angel group. Many are kind of members of their own group of other like-minded people who also do investments. So it's not a formal group, but they'll tend to make introductions to a company and to 5 or 6 or 8 other people they know, and say, hey, we've invested in the past together, and here's a company you may be interested in.
Okay, great. So that said, what kind of companies do they invest in? What are the ones that really get angels excited?
Well, there are 2 things. One, angels typically don't have the opportunity to invest in later stage companies. If you're not in from the very beginning, you're probably not going to get in at the C, D, and E rounds. That's almost exclusively left to the large institutions. So by definition, angels tend to be early stage investors. They invest mostly in technology, clean tech, fintech, healthcare, all kinds of subsectors of technology. You'll find, people you can still consider angel investors who also do some investing in things like restaurants or bars or other retail kinds of businesses. But for the most part, the angel that we think about is somebody who focuses on tech companies. They're often looking not just to make money, and it's not that a solid return isn't important, but most often people are looking for more than that. They're looking to be actively involved in a company. In some ways, it's kind of like they're sort of looking to relive the parts of their lives they really loved. So maybe they're now working in a giant corporation, but at one time they were in a startup and they missed that, and this is a way of being actively involved. Or it may be somebody who spent an entire career in, I'll make this up, enterprise sales, really loves enterprise sales, thinks he has a lot to offer to a startup who has some need for advising on enterprise sales and really wants to just sort of, in a way, give back. And be part of helping build another team, even though it's not really his job. In other cases, you'll find people who just really get excited about a particular industry. I know a number of angels. They're really active angels. In some cases, they put maybe a few $100,000 a year into multiple investments, but only in clean tech because that's what they've really got a passion for, or only in financial technology companies because that's where they've spent their entire careers, and they know a lot about finance and know a lot about the inadequacies of fintech in general, and feel really competent to be an active investor and supporter in that industry. So one thing to think about when you're starting to look for introductions to potential angel investors is to find some way to connect. Look for somebody who is in some way connected to or could be interested in what you're doing. If you're an ed tech company, look for people who have a demonstrated passion and background in ed tech, investing in ed tech, being in ed tech, senior positions in ed tech, and so on.
Great. We have our first question here from Jay. It's kind of a long setup, but I think it raises a couple of interesting questions. So I'll jump in with it now, even though you might be hitting on some of this stuff a little bit later in this presentation. So Jay's question, he's saying too many investors, while extremely knowledgeable about business, are not as knowledgeable about science and the economic impact certain products can have over the long term. He's saying it's kind of a different type of quote-unquote unicorn because these types of discoveries take a longer time to get ROI, but it is a longer-term return, and there's usually more cross-platform opportunities. So, I mean, his specific question was, do you or any other angels or investors get involved with these kinds of longer-term opportunities? But he's also wondering, obviously angel investors or any investors are looking for, the ROI. So what's the best way to communicate these types of longer play opportunities to investors?
Mm-hmm. I think Jay and I should go have a beer sometime. And I can talk at length about this because this has long been one of my big complaints about Silicon Valley. When we were starting Seed Change, we tried to talk to as many people as possible, bounce our ideas off people, get feedback and criticism. And the question, I'm sure the question I heard most often was, what do you like? And the answer really was, well, what if we're not exactly like anything? No, what do you like? What do you like? And everybody's looking for, let's say, the Uber of something. And I started telling people that, Silicon Valley has really lost a lot of its innovation, its passion for innovation. It's more like Hollywood now. People seem to be looking for the sequel to the last blockbuster. So I think Jay points to a really hard problem, is that there are a lot of investors, and it's not just angels, it's institutions as well, who are looking to get on what they see as the next big bandwagon and ride the momentum play. So we talk about this as in early stage companies, as in public companies or any other asset class. Momentum investing, unless you're a day trader, is not a great investment strategy. So I think you need to find people who are more thoughtful about it. There are actually people out there in angel investors, in some cases, some institutional investors like family offices and so on, that really do seek out these kinds of long-term plays. Much more interesting in something, in taking a risk on a company that is that's kind of a long shot, but if it works, it's going to be really, really interesting. And I think you need to deliberately seek out those kinds of investors they're going to be willing to go along for the ride. They're going to be willing to take this as a 10-year plan instead of a 3-year plan. And in some cases, you can find investors that make it really clear that these are the kinds of opportunities they're looking for. I've come across investors say they only want kind of deep science-based companies. There are some like Peter Thiel and Elon Musk who talk really frequently about the fact that they're looking for major game changers, which by definition are a little bit riskier investments and longer-term investments. And as any any sales process, and this is really what this is, you're selling your company, your product, yourself, the investment opportunity. As any sales process, you want to try to define really early whether the investor you're talking to is actually interested or not. And one way that I try to do that is I tell people that we're really interested in companies that are somehow different. We're really not, if Snapchat had come to us, I would have turned them down, and I don't regret that. I mean, they didn't, so I don't have any regret. But if they had, I would have turned them down, and I wouldn't have regretted it because it's not really the kind of thing we'd be interested in. We really are interested in things that have the potential to be strongly additive in some way or another.
Right. Interesting. Okay. Thank you. So that takes us to, okay, where do entrepreneurs find these angels? How can they make that connection?
Well, one thing to think about, one of the things that we discovered in talking to both investors and to companies, founders of early stage companies, is that by and large, looking for angel funding is about a 6-month process. And we're only talking about raising $500,000, $600,000, $700,000, right? We're not talking about a major amount of money. And in some ways, maybe that makes it harder because typically angels are going to be investing $25, $50, maybe $100,000 a pop. So if you're trying to raise $500,000 or $1 million, you're going to have to kiss a lot of frogs before you find the princes. So recognize that by and large, most people have to make this a full-time job. It's about all you're going to be doing for several months, and you should start with your network. If your network isn't solid enough, you're going to have to expand your network and then work with that network. You're going to have to try to find probably at least 100 or 200 potential investors that, based on experience, based on their track records, could be interested in what you're doing. And you're going to try to get introductions to them, and out of that 100 or 200, if you're really good, you may get introductions or meetings with about half of them, and you'll have follow-ups with many of them. And at the end of the day, you'll probably get checks from maybe 10% of the people that you've approached. It's a long process that requires a lot of follow-up meetings, and it was one of the things I found most frustrating, and one of the things I thought we could help solve is that you don't really know when you talk to an investor what he or she's going to really be interested in. What's the investor going to ask? What kind of data does he want to see? How does he want to see it? And the way it normally plays out is you get a meeting, and maybe it's in a Starbucks, and got a little bit of a deck, and you can talk through, and at the end of that 30 or 60 minutes, you'll try to get another meeting, and the investor will probably say, well, I'm going to need something else, and he'll tell you what that is. Maybe it's financials, maybe it's your go-to-market, or some piece of information. And so you sort of run home and you'll update whatever that is, and you'll send it to him, and a couple of weeks later you'll get to meet, and at this time you may have a different question and ask for some different materials, and you'll go home and prepare that, and so this is part of the reason this drags out for such a very long time. Another reason is that as you find in the world a lot of people who are really interested in this, not necessarily investors. And so it's hard, but it's critically important to try to distinguish early on how serious somebody is. You don't want to end up wasting 20 hours with somebody who's actually never going to invest, and I've seen that happen probably hundreds of times. It's honestly one reason angel groups, formal angel groups, have developed a bit of a bad reputation. Many of them seem to be more social clubs, and the members love to hear about companies. They rarely write checks. So like any sales process, I'd start with sitting out, developing the list of people you're going to contact, and then you start kind of dialing for dollars.
Right, right. Okay, we have a couple of questions here. One is from AJ. So he, as you described this process, it's pretty exhausting. And you said, Seed Change, your goal is to help this process a little bit. So what does Seed Change do to change or shorten or abbreviate or help this long drawn out process?
Well, if it's okay, Jay, I'd love to talk to you about that offline, and you'll get my email after this webinar is over. But I don't want to make this an infomercial. But in short, what we tried to do is provide a process that's transparent, that is well known, that is much more standardized, and in some cases automated than is available in the real world. So instead of having to go round and round and round and chase people all over the Bay Area or parts of the country trying to get meetings and pursuing those meetings and following up, our thought was work with a single, in our case, investment firm that can help make that process go a lot faster, a lot more easily, by reaching out to investors, just the way that an investment bank does for a public company that is, I would say, IPOing. So the process is really similar.
Great, thanks. So yeah, AJ, if you have follow-up questions or if anyone else does, at the end you'll get some contact information. So feel free to follow up with Kevin after the presentation. One more quick question. I don't want to delay us too much. We still got a lot to get through, but a question here about timing from Aga. So he's saying, when do you start looking for angel funding? Everyone always says when you're getting some traction, but he gives a sort of specific example. What if you're B2B and your sales cycle 6 to 9 months, you're small, just a 1 to 2 person startup and ramen profitable, but you need money to scale? Can traction then be, 3 paying customers, or is it 100? Like what is real traction?
Well, that's going to depend on the investors you're talking to, and you're confronting some real challenges. The enterprise market hasn't been very interesting from an investor point of view for a few years. It's changing. I think the last 6 to 9 months. Well, we've seen a lot more interest in the enterprise market, but it's still a hard sale to investors. It's hard for your average investor who doesn't have any experience in enterprise software, for instance, to get really stoked on this because it's hard to understand the impact. And so it's a longer. I think it's a longer sales process to investors with enterprise products than with many other subsectors. So I would say start early, and the way to start early is not actually by trying to raise funding, but by seeking advice, in thoughts, feedback from people who may then ultimately at some point become investors. We found when we were doing this, and we were really clear that we weren't looking for funding when we started off, but we really wanted to know. We wanted people's feedback. What was wrong with the way we were setting things up? What was wrong with the way our product had been designed at the outset? What was wrong with the way we were structuring the company? And we find that virtually, it's one of the great things about Silicon Valley. Virtually anybody out here is willing to give 15 or 20 minutes of their time to provide some thoughts, some feedback, maybe some advice. And you'll also find that at the end of that, if that conversation has gone really well, you'll find a lot of people who will say, "Hey, when you get ready to raise funding, ping me. I don't know if I'll be interested, but I might, and I might also know some other people who are." So you're right. It's a very long sales cycle, raising funding for your type of company. Start early. I'd also say that because it's a different market, it's a different product, Traction as defined tends to be a little bit different. What I want to see, not that you've got 1,000 paying customers, I'd be more excited about seeing one solid paying customer that has been with you for a while, that has given you a lot of feedback, that has allowed you to develop the product in a way that is probably going to be more exciting for a lot more customers. Use that that one or two or three users as development, as testing tools, and seeing somebody who's willing to do more, but who's willing to pay for your product is a lot more important, I think, than seeing 1,000 people who've been willing to give it a go once.
Right, great. We have more questions, and that's awesome. Everyone keep pouring in your questions, but we're going to move on a little bit, and we will get to questions as we go through. So speaking of questions, what are some of the common questions that angels are asking? What do they want to know about you and your company and your product?
So there are a couple of things here, and this slide is about questions that angels ask, things you ought to be prepared for. If you've ever been to a webinar, done any reading at all about what should be in your pitch deck, it's essentially this stuff. People are going to ask you, well, help me understand your product. Why do you think people are going to use it? And really importantly, how are you going to make money? This a little bit goes back to the question that I just had, which is, I need to know, I need more than users. I need a real clear path to revenue, and ultimately some believable path to profitability. Although in the early stage, I really am much more looking for how do you think you're going to get people to pay you money? And then, important piece is how big is your market? And you'll find a lot of investors who will say they're only interested in companies that have the potential to be a billion-dollar company. Honestly, I think that's a little bit of nonsense. You can get a great return from a company that's smaller than that. I think if you're out seeking unicorns for every investment you make, it's like going to Vegas and saying, I really am looking for that big pot. It's a gamble. And there are plenty of investors, I think, who are a little bit savvier than that and understand that a $100 million company can be a superb success. And maybe a $50 or $80 million company can be a great success. So, but you need to have an answer for how big is your market, why do you think so, how are you going to get your product distributed, and really importantly, what's the data behind it? How many customers have you talked to? How many people have been using your product? How have you demonstrated the term that everybody loves to throw around, but I think is a really, really important one and was an insight in the development of startups a few years ago is, product market fit. What is it? How can you be sure you've got it? You don't want to be growing at all until you're sure that you've got product market fit. And then people will ask them some basic questions about who's the founding team, who's on your team, how did you meet, why do you think you can work together, how do you work together, what are your biggest challenges right now, what keeps you up at night. May ask some questions about your tech and your IP, depending on how important that is to what you're doing. And ultimately, and this may not come in your first or second or third meeting with an angel investor, but how much are you looking for? What are you going to do with it? What are the milestones that this amount of funding is meant to take you to? And how much are you going to raise or need to raise once you get through this amount of funding, and what are you going to do with that amount, that new round as well? Now, this is all fairly straightforward stuff. It's the kind of questions you ought to have an easy answer for, really clear data-based answers for before you draft a pitch deck, before you get any meetings with investors. But moving on to the next section, you ought to also have answers to questions that angels don't usually ask you out loud. These are questions they ask themselves, questions that are in their minds, questions they may be asking. Maybe they don't ever get so concrete as even to ask these, but sort of intuitively, these are answers they're trying to get to. What's the founding team really like? Do you guys like each other? What do you do when you're not working? Do your significant others know each other, like you? Do you enjoy the same things? Where did you meet? What's the context in which you guys all formed a team? What's driving you? And what people are really getting at is, by now people understand that the primary cause of early stage startup failure is founder problems, team dissolution. So people really want to try to figure out, are you guys going to be here for the long term? Are you going to be able to get together, get along together, work together? That's not a question you're going to ask straight up, bluntly, and out loud, but they're going to try to figure out the answers. Along with that, if things work out well, these investors are going to be pretty close to you for a long time to come. So one of the questions they have is, do they like you? Do they trust you? Do they believe in you? Are you a straight shooter? Can they believe that you're going to give them bad news when bad news is there to be disclosed? Will they believe the good news? Those are all, again, those are questions you can't ask out loud. They're not questions you formulate, but it's a question that an investor needs an answer to. Another question is, how good are you, the founder? In most cases, this means the CEO, but how good are you at selling? One of the most interesting bits of feedback I got was a guy who was PhD in biochemistry, had been chief scientist and later CEO of several private and also public biotech companies. And now in his 60s, what he does mostly is act as temporary CEO, does a lot of investing, has a target of putting about $500,000 a year into early stage companies. And when we were talking to him about the decision-making process, he said, in some ways it's kind of easy because he knows within 10 minutes whether or not he's going to be interested in this company or not. It all depends on the presentation skills of the founder. And I thought that was the dumbest thing I'd ever heard a really smart guy say, and we talked more about it. And what his point was, look, the most important thing that a CEO does is sell. You're selling your company, you're selling your product, you're selling to investors, you're selling to potential hires, you're selling to partners. All you're doing really all day long, every day of the week is selling. And if you're a lousy presenter, if you can't sell one-on-one to me as an angel investor, you're not going to be any good selling in the other circumstances you've got to be selling, and that is not going to be a good long-term investment. Other questions people want to know. A founding team inevitably has giant holes. There are holes in skills, holes in the experience or background level. So you're going to have to build a team. You're going to have to build a pretty fundamental, important core team, but then you're going to also, assuming things go well, you're going to want to ramp up and grow that team. Can you do it? How do you know? Do you have a network that you could draw on or access to networks? How are you going to be able to grow the company adding 20, 30, 50 people? Can we work together? This goes back to, do I like you? Do I trust you? What's it going to be like? Naturally, people want to know. There's a very much a herd mentality in investors and among investors of every asset class, every stage. People want to know, is anybody else investing? I don't want to be the only one, usually. So, what's the process like? And another question people are always going to have in their minds, really, how are you going to keep Company A from finding out about what you're doing and just blowing you out of the water?
This kind of leads to this non-rational criteria, if you want to talk a little about that.
Yeah, so thinking back again to how people thought, how this guy, whose name I won't disclose, but he talked about the importance of presentation skills, and so much of presentation skills is nonverbal behavior, or maybe non-rational criteria. A lot of what investors are looking for is, in some ways, somebody that they can identify with. Maybe it's because you come out of the same industry. Maybe it's because you're an alumnus of the same university. Maybe it's because you're in an area, a field that they're really passionate about. But there needs to be something, some hook, some connection, more than just money. Another is, sometimes people get really excited about the product. Is this somehow cool? You're seeing this, for instance, in what happens with cryptocurrencies. There are a certain number of investors that get really excited about this. This is really cool. I may not even understand it altogether, but it's cool. And hey, I'd love to be able to tell my friends that I've just dropped $50,000 into this new Bitcoin exchange because it sounds cool. Again, I may not understand it, but it's a cool thing. And here, I may not primarily be interested in making money. I'm more interested in the investment itself. Sometimes people get really excited about something that solves a personal problem. I think the company Urban Sitter is a classic example. Many of the early investors in Urban Sitter were young moms who were like, my God, I wish I had this service available. It should exist. If you're not the ones, it definitely should exist in the world, and I'm really happy to do what I can to try to make it appear so that other moms won't have the same problems that we've had. And then sometimes people look at this from the point of view of the market. It's something a lot of people are really passionate about, clean tech. A lot of people are really passionate about ed tech, whether or not they have backgrounds in those things. It's something that they really see an ability to invest their time as well as their money and somehow make a difference in the world, and that's important to them.
So you want to speak a little bit to the decision-making timeline?
So as I said when I was talking early on about what we were trying to understand in the way early-stage investors make decisions, so we could figure out, sort of graph out what's the process like from that first intro to the check. We laid out a timeline, and again, as I said, it's typically 4 to 6 months to raise a full round. I think it's gotten a little bit compressed over the past maybe year. You've seen that there's a lot more money chasing startup investors now than was true, 2 years ago, definitely true, and then was true 5 years ago. So that timeline is a little bit, in many cases, a little bit more compressed, but still, this is generally the way it goes. It probably is going to take you, on average, about 6 meetings before you get somebody to write a check. I really frustratingly have spent 10 meetings with an investor who ultimately decided not to invest, and to my mind, that was kind of shame on me, but because I didn't figure that out earlier. But that happens. I have had as little as 2 meetings before somebody was able to get comfortable and interested and write a check. But neither one of those, I think, is typical. In the early stages, questioning and really your presentation is a lot more general. You're presenting in really high-level terms your company, your product, and yourselves. If you make it past those first couple of meetings, it'll switch into more detail, where investor now is trying to get answers to questions that are much more specific around, often involving data, so growth, traction, financials, things like that. And here there are a couple of purposes of this. One, it's sort of a check the box. Investors, anybody who's done any thinking about this really recognizes that you shouldn't just NIMBY write checks here and there. You should feel like you've checked the boxes. You've really confirmed that this company exists. You've confirmed that there are sort of basic elements that any investor should be doing when conducting diligence on a potential transaction. The other thing it solves is really trying to get enough information about what you're doing that you can that an investor can kind of sell himself, sell in many cases his or her spouse on this investment, because it's pretty common that an investor is going to seek at least sign off from a spouse or significant other before making an investment, and feel comfortable that he or she can also sell this to friends and to other potential investors. So that process probably takes 3, 4, 5 meetings, and it'll bleed over into at some point the actual terms. It's not all that common to have to negotiate terms in early stage deals, and in fact we're going to do a presentation webinar in a few weeks on convertible notes, and we'll talk partly around why that's the case and why convertible notes have become the most common, by far the most common. In fact, almost all early stage deals in Silicon Valley and other tech centers around the United States are done using convertible notes. And part of the reason for that is that terms have become really kind of standardized, and there's just not much to negotiate when you use convertible notes. So the amount of discussion around terms is usually pretty quick, pretty short. Probably not a lot of negotiation to be done there. And if we go on to the next slide, we've actually broken this down to kind of the way this plays out. There's a little bit of path dependency depending on the product you're in and the stage you're in and the information you provide to an investor. So an investor may take one route or another, particularly when it comes to delving into the market or the product. But by and large, in the early stages, what you're really not trying to sell the investment. You're really just trying to sell a green light or buy a green light. All you want is for an investor to agree to give you a little more time. So an elevator pitch is typically what you start with. An investor wants to know really concisely what it is you're about, and that may be a 60-second pitch, and at some point during that pitch the investor mentally is making a decision: am I willing to invest another 5 or 10 minutes into this person and this company? And if the answer is yes, then what he wants is a little more information that falls into what's contained in the pitch deck. More about the product, the market, the business model, how you're making money, who the competition is, and who the team is. And when it comes to the team, you're going to be looking a lot more into really concrete data like background, domain expertise, but also into soft skills like your presentation skills and what kind of integrity I think you have, and are you really going to stick with this? Are you going to give up in 6 months? Because this is really hard, and we know that this is really hard. Do you have what it takes to stay at it for the next couple of years when it frankly really sucks and you're not making any money? So that's by and large, that's the order that people want to answer questions. And at every stage, what you're getting, what you're hoping to get, is a gate to proceed to the next stage, really to get another increment of time from the investor. And once you get to, if you go on to the next slide, once you get to the farther parts of the process, so you're talking, pretty heavily about financials and about milestones and even about what amount of money you're looking for, who else is in the deal. That discussion should tell you that you're pretty far into the process with this particular investor, and you're getting pretty close to being able to get a concrete yes or a no on whether he or she is going to invest a certain amount of money and what that number is. And really the last stage, and this was interesting, one of the things we did is we put out a list to a few hundred investors of the kinds of data that people typically look for, and the list was had about 38 different items on it, and probably to nobody's surprise at all, the legal stuff was at the very end of the list. That was the stuff investors got and looked at absolutely last.
Yeah. So we're going to shift gears a little bit here and talk a little bit about when you have that opportunity, you're green lighted to that stage where you can actually pitch to the investors. What's the best practices here?
So, at this stage, and over the past 20 years or so, in probably 6 different countries, I've sat through, I don't know, maybe 10,000 pitches. And I'll tell you, one of the things that people who do well get right, and a thing that people most often get wrong, is there's no narrative, right? A pitch should be telling a story. And it should open up with something that gets me really interested. And think about the way a news article is structured, for instance. The really good stuff is in the first paragraph. And if you keep, by the time you get to the very end of it, you're down in sort of kind of less interesting details. But we start off with getting somebody really interested. And the way you get somebody really interested and really pique their interest is find some way of telling a story, and your entire pitch should be kind of unfolding this story. So I was in a pitch event last week, and 5 different companies pitched, and we were giving feedback to each company after the pitch. And so by the time we got to the 5th, we found somebody who did it. But the first 4 were standing up and kind of throwing a lot of facts out into the world. And we were having a hard time aggregating and forming those facts into sort of a meaningful company, because there was no context in which those facts played out. So start by giving the investor a framework as you go through the pitch. You're going to, think of it sort of like build a bookcase, and then you fill it up with all the books. But don't just throw books at me. And one of the things that's really important to get is what's the problem you're trying to solve, and frankly, why? I mean, why? I kind of you may have identified a problem, but I'm also really interested in knowing why. How did you define that problem, and why do you even care? And why do you think this solution is a potential good fix for it? Other questions, pretty commonly, you've heard this before. To help me understand what the market is, how you're going after the market, who else is in the market. Please don't say that there's no other competition. There's always competition. If you've got a business plan and you've got a path to revenue, then you're always competing. Even if there's nobody else, no other product like this, you've still got competition for those dollars, because the dollars are finite. A potential buyer is going to be making a decision whether to allocate that money to this product or a different product. And so there's always competition, and it's really important to understand how you see that world. And then, as we've said before, team is critical. A couple other points. Err on the side of small. It's really easy to put together a 25-page pitch deck. It's really hard to put together an 8-page pitch deck, because inevitably you're going to feel like really important stuff is missing. And that's just the point. Focus in what is the really, really, really important stuff. And by getting your pitch deck from 25 pages down to 8, you're going to have refined it, and you're going to have gotten really clear answers in your mind to all the questions that are going to come up, and you're going to be able to talk about and tell the story so much more fluidly than you would if you just left it with 25 pages.
Okay, and really shifting gears here. Just a few words about valuations. This comes up a lot. What's the valuation of your startup, and how do you figure this out?
Well, and we put this slide in because it was such a big question and previously when we've given this webinar. Mm-hmm. and it's not one that I want to spend a lot of time on because in a way I don't think it matters. The valuation is one that you can reach agreement on that's going to feel fair to you and fair to investors. And it's hard to figure out what that number is because probably by definition, you're a startup. There's not a lot of public data out there. There aren't companies that do for a living valuation of early stage companies and put this data out there. So it's a little bit of a guessing game, but you're going to base it on the traction you've got, the resources you've got, the stage of your product, the amount of revenue you are currently generating, the growth in the amount of revenue you're generating, and to bottom line, one of the great things about convertible notes is you don't have to come up with a valuation right now. The principle of a convertible note is we're not going to value the company. The company is going to be valued. Our shares are going to be valued at whatever the valuation is in the next equity, in the first big equity round. And we as investors are kind of agreeing to let the major investors in that equity round help figure out what the valuation is. We're not going to have to do it.
Gotcha. Okay, well, I think that takes us here to the end. We have a number of questions. They're kind of all over the map here, so I'm just gonna pitch them at you, and see how far we get. Okay, so first, we have a question here from Phaeton that's specific to them, but I thought it has a good general question here. We're saying we're based out of Maryland. Would you recommend we move west to get in front of the right investors? And in their particular case, they're an e-commerce startup within the fashion and luxury market. But I think the bigger question here is, if you have to be in Silicon Valley to find angel investors, or
oh boy, this is just such a hard question, and this goes back to actually why we started Seed Change. Is I really thought that a great founder coming out of Georgia Tech and living in Atlanta shouldn't have to pick up and move to one of the most expensive places in the world just to get the company up and running. I also think that lots of tech centers, sort of mini Silicon Valleys in a way, have grown and increased in size and sophistication and the resources they're able to provide in lots of places around the country and in lots of cities around the world too. So it's less and less necessary, I think, to do that. Now I'm going to argue against that. At the end of the day, this is still an industry town, and in the same way, if your passion was acting, you probably have to move to LA or New York, or if you were dying to get in politics, you're certainly going to end up in DC. I think there's a lot to be said for moving to a place like Silicon Valley, and San Francisco really is part of that now, because you're going to be surrounded by a giant ecosystem that has grown up and is really used to and offers a lot of resources for early stage companies. So I'm not giving you a great answer. I don't know if you should do it or not, but I used to think you definitely shouldn't have to do that. Now I've come over the past few years to thinking that there still are really good reasons for moving to a place like Silicon Valley. That's going to vary a little bit on what your industry is. You're in fashion tech. New York and to some extent London are pretty big centers of fashion tech as well. So there could be an argument that you might not have to move across the country. Maybe moving to New York is a better option.
Right. Oops, sorry, I just made that go away. Let me leave that contact information up because we have lots of questions and I don't think we're going to get to them all. Okay, no, you're doing a great job. You just have so much information that people have lots of questions, and a lot of questions here about convertible notes. So that definitely, guys, we're going to post soon the registration page for our upcoming webinar on convertible notes. So if we don't get to all those questions today, definitely attend that webinar. John is asking, let me see if I can kind of parse this. He's saying in his experience, most angels effectively try to set the valuation with a convertible note cap. He's wanting to know if that's true. He also says that he believes that seed funding rounds shouldn't try to guess the valuation, but most angels try to set such a low cap that the next funding has to exceed it. What are your thoughts about that?
I think all those are good points. Those are all issues that you'll encounter. It's very geographically driven, so you'll find, for instance, that in the middle part of the country there's general aversion to convertible notes. I'm gonna generalize grossly, but by and large, in the Midwest, and the Midwest stretches from just barely inland on the West Coast to just barely inland on the East Coast, for these purposes. Most angel investors want equity. They want ridiculous valuations. They believe that a company with $1 million in revenue should probably be valued at something around $1 million, give or take a few $100,000, and they think that for their $50,000 they should get 5 or 10% of the company. In my mind, again, I'm grossly generalizing, but that part of the country is sort of 15 years behind the rest of behind the coast and in other parts of the world even when it comes to that. So it is a reason that it's worth seeking investment outside Maryland or other places you're in. I think there is a fundamental misunderstanding around what a cap is. A cap is not a valuation. A cap really is anti-dilution protection for the investor, but it's not a valuation, and some investors, truthfully, also misunderstand that. I think it's not terribly important, really, what that cap is, to be honest. Frankly, the difference between a $5 million cap and a $10 million cap, when it comes to conversion, is not going to be huge, and I really do think that, by and large, if somebody is really aggressive on negotiating points like that, it's probably not a great investor to have around.
Okay. Before, you're talking about that pitch deck competition that you were at and sort of the feedback you were giving people. Someone's asking here, where would they go to find events where founders can go up and practice their practice their pitches and get that sort of feedback from people like you?
Oh, that's a good question. There are some public and kind of informal pitch, pitch contests, pitch presentations, where you're not actually looking to get investment. And that's not the purpose. Although the people on the panel are probably investors, and sure, if you hit it out of the park, you may well get people approaching you afterwards looking to invest. But that's not the purpose, and so it takes a little bit of the pressure off. And in the Bay Area, at least, it should be really easy to find those through various meetups or other organizations. At the Vault, we do this regularly for our members. Again, it's a totally low-pressure way because I think it's hard enough, and one of the things you really need to do is practice, practice, practice. I'd suggest, even if it's hard finding those kinds of opportunities, hey, practice in front of friends, practice in front of family, and set it up as an actual presentation, because you're going to find you're going to get so much more fluent as you do this, and the first time is going to be dramatically different from the last time. And I'll tell you another example. 6 months ago, I saw an informal kind of pitch for somebody, and it was kind of incoherent, really awful. And very recently, the same person gave a pitch, same company, and was just dynamite, absolutely hit it out of the park. And it all came from having done this over the course of 6 months, just practicing.
Well, that's inspiring. I think we just have time for one more quick question. So I think this one you can probably answer quickly. Tracy wants to know, what's your advice regarding asking angel investors to sign a non-disclosure agreement? Don't
ever do it. It's a really easy one. Just don't ever do it.
Yeah. I figured you could answer that one pretty quickly.
Yeah, few investors will agree to do it. Everyone will take it as a sign of real naivete and lack of sophistication that you're kind of, this is your first rodeo. So it's not worth it.
Yeah, okay. I figured it was more believable coming from you to answer that, but yeah, we hear that question a lot. So I know we have some outstanding questions on convertible notes, but you know what? I'm going to let them lie, and I'm going to ask you all to come and join Kevin and me for our upcoming webinar in May when we're going to be talking about that topic specifically for 40 minutes. So for now, I just want to thank you all for joining us. I hope that you found this useful. Again, you'll receive that follow-up email tomorrow, which will contain a link to the deck and the recording, so you can reference back. And if you have any questions, you see our contact information here, so feel free to follow up. Our next webinar is 5 Essentials to Build Startup Sales Momentum, and that's going to be with Michael Hess from Core 6 Management Advisors, and it's on April 24th. So if you're interested in that webinar or any of our upcoming ones, please just go to our website and check out our events page. Thank you, Kevin. Once again, awesome presentation, and thank you so much for your time.
Thanks, everyone.
Okay, have a great day.